Welcome back to Iron Financial. We're the channel that forges stronger portfolios by cutting right through the market noise. I'm your lead analyst, and today we are taking a high-powered drill to the foundations of an absolute titan, Procter & Gamble. Their latest earnings report just dropped, and it's got Wall Street asking one huge question. Is this consumer goods fortress still built on solid bedrock, or are we finally starting to see some serious cracks emerge? And, to keep me honest, our market skeptic is here. His job is to call out the corporate speak, so let's get to it. We're going to tear these numbers apart, stress test the entire structure, and figure out if P&G is a place to build your capital or if it's a trap waiting to collapse.
Now let's be crystal clear about what we're dealing with here. P&G isn't just another company you see on the stock ticker. This is a financial institution. It's a core holding, a blue-chip behemoth that anchors millions of retirement portfolios around the globe. It's probably in your 401k right now. We're talking about Tide, Pampers, Gillette, Crest, brands that are in virtually every single household on the planet. So when a company this foundational, this woven into the fabric of the global economy, starts showing signs of stress, every serious investor has to drop what they're doing and pay very close attention. This isn't just a stock report. This is a barometer for the health of the entire global consumer.
Okay, so this is the official word coming down from the command center. The president and CEO stepping up to the microphone, projecting strength, telling the market, hey, don't worry about this last quarter. The plan is working and the back half of the year is going to be much stronger. This is classic corporate messaging. They're trying to calm the seas, reassure investors that they have a firm hand on the wheel and that this is just a little bit of turbulence, not a fundamental change in direction. It's the stay the course, we've got this speech.
Whoa, hold on a second. Confidence? That's a nice word. You know, I've heard a lot of confident CEOs right before their stock falls off a cliff. My job here is to ask the question, is this real, battle-tested confidence born from solid data, or is it just the corporate jargon they're paid to say to paper over some really deep cracks? Talk is cheap. The numbers don't have a PR department. The numbers are what tell the true story. So let's blow past the press release and see if that confidence is actually earned. Okay, let's start digging. First number on the docket, net sales. And it's up a whopping 1%. Just 1. Let me put that into perspective for you. In an economy where the cost of everything has been going up, a 1% increase in sales means you are effectively going backwards. You're not even keeping pace. It's like running on a treadmill that's slowly speeding up. You're working harder and harder just to stay in the exact same place. Sure, technically it's a positive number, but it is not a number that screams strength. It screams stagnation. But honestly, it gets worse. This right here. This is the number that should really grab you by the collar. Organic sales growth. Now, this is the pure number. It strips out all the noise from currency swings and acquisitions to show you how the core business is actually doing. And the number is a big, fat zero, a flat line. The engine has completely stalled. Just think about that for a second. With all of their marketing genius, all their innovation, all their incredible global reach, the net result was zero, nothing. This is a massive red flag being hoisted over the fortress walls.
And now we move from the stagnant top line down to the bottom line, what actually matters to shareholders. Diluted earnings per share, and it's negative, down 5%. So let's just piece this puzzle together, shall we? You've got sales that aren't even keeping up with inflation, you've got a core business that generated zero growth, and as a result, the profit that's supposed to flow to shareholders is actively shrinking. This is financial deleveraging. The pressure is coming from the top and squeezing profits out before they ever see the light of day. These headlines are not just bad. They're deeply concerned.
So to really understand that flat 0% number, we can't just look at the fortress from the outside. We have to go inside. A company like P&G isn't a single block of concrete. It's a massive structure held up by gigantic pillars, its core business segments. You don't judge the health of a castle by its tallest turret. You have to go into the foundations and inspect every single load-bearing pillar to see which ones are solid steel and which ones are starting to turn to dust.
And this chart tells you everything. This is not a story of uniform weakness. This is a story of a great divide. It's a tale of two P&Gs. Over on one side, you have beauty and healthcare doing all the heavy lifting, posting real, solid growth. These are the modern reinforced steel pillars. But then, you look at the other side. Grooming and fabric and home care are dead flat, stagnant. And then you see it, the gaping wound. The baby, feminine, and family care segment, historically one of the most critical pillars of this entire company, is down a shocking 4%. This fortress is dangerously unbalanced.
Now let's give credit where it's due. The strong pillars are performing incredibly well. In beauty, they're not just jacking up prices. They are seeing real volume growth in hair care. That means more people are actually choosing their products off the shelf, which is huge. And they are successfully pushing those premium, high-margin skincare products in the all-important China market. In healthcare, it's a story of what they call favorable mix. That's just a fancy way of saying they're convincing you to buy the more expensive, higher-profit toothpaste and vitamins. The strategy in these segments is absolutely working. They are the growth engines.
Okay, analysts, that's the good news. But this is a 5-alarm fire. A 4% drop is bad enough, but look at family care. Down double digits. That's not a crack. That's a full-on collapse. That's a cornerstone crumbling. And my biggest question is about baby care. This segment, home to the iconic Pampers brand, is supposed to be the absolute bedrock of this company. How can a pillar that large be shrinking? A decline in unit volume is terrifying. It means fewer parents are buying their diapers. This doesn't feel like a bad quarter. This feels like structural decay in one of their most important businesses.
And this table right here, this is the smoking gun that explains everything. Just look at that bottom line for total P&G. They pushed through a 1% price increase across the entire company. In a normal world, that should lead to 1% growth. But look what happened. It was completely, perfectly, and utterly wiped out by a 1% decline in volume. People bought less stuff. 1 minus 1 equals 0. This is the very definition of spinning your wheels in the mud. It tells you that customers are finally pushing back on price hikes. P&G might be losing its legendary pricing power, and for a consumer goods giant, that is a terrifying development.
Okay, so we've established the foundation is flat. Revenue growth has ground to a halt. So what happens when the top floor of the fortress stops growing? Well, all that weight, all that pressure gets transferred downwards, squeezing every other part of the financial structure like a vice. The critical question now becomes, how is this stagnation affecting profitability? It's time to follow that pressure down into the guts of the income statement and see where the real pain is being felt. Let's look at the margins.
And hold on. Right away, my alarm bells are going off. The first thing I see are two different sets of numbers. You have GAAP, that's the official by-the-book audited accounting number. It shows a steep, very ugly 120 basis point drop in gross margin. But then management presents this other, friendlier number they call core, which is only down 50 basis points. So what gives? What are they trying to smooth over for investors with this special core metric? When I see two sets of books, my skepticism meter just pegs out. What exactly is hiding in that 70-point gap?
So here's the company's official explanation for that gap. The difference is something they call incremental restructuring. Let me translate that from corporate speak into English for you. It means P&G is spending a boatload of money to reorganize the company, sell off brands, and try to cut costs. And management's argument is, hey, those are one-time charges, so you should ignore them when you're judging the real, ongoing health of our business. They want you to focus on the pretty core number as the true signal. Okay, fine. Let's play their game and use their preferred core numbers. Even then, the picture is grim. Look at this. It's a story of a battle. On the positive side, they did an incredible job with productivity savings, adding a massive 160 basis points. That is fantastic execution. They also got 50 points from price hikes, but then look at the negative side. It was an absolute onslaught. All of those gains were completely devoured. They lost 120 points because people were buying cheaper products. They lost 60 points on reinvestments, which is usually code for more promotions and coupons, and they lost another 60 points to tariffs. All that hard work was wiped out and then some. They are fighting a war on multiple fronts, and they are losing.
And that pressure, it just cascades all the way down the income statement. Operating margin, what's left after all the core business expenses are paid, is down a shocking 200 basis points on a GAAP basis. 2 full percentage points of profitability gone. Even with their own adjusted core numbers, it's still down 70 basis points. There is no positive spin you can put on this. The business is becoming fundamentally less profitable. The squeeze is real, it's happening now, and it's damaging the entire financial framework of the company. The walls are closing in.
So far, the story looks pretty bleak, doesn't it? A flat foundation, crumbling pillars, squeezed margins. You'd think this fortress is on the verge of collapse. But every great fortress has a keep, a heavily defended inner sanctum. For P&G, that's the engine room. It's their legendary, world-class ability to generate absolutely massive amounts of cash. So now we ask the most important question of all. Is the financial engine still powerful enough to withstand this assault on growth and profitability?
And here it is. Just look at that number. $5 billion. That's the operating cash flow that P&G generated in a single 90-day quarter. This is the undeniable, unimpeachable strength of the fortress. This is the entire bull case wrapped up in one number. No matter what's happening with sales or margins in the short term, this machine continues to print cash. This is the financial bedrock that allows them to weather storms that would sink almost any other company on Earth. It's an incredible, almost gravity-defying number.
And it's not just the sheer amount of cash, it's how efficiently they create it. This number, 88%, is their adjusted free cash flow productivity. All that means is that for every dollar of accounting profit they report, they successfully turn 88 cents of it into cold, hard, spendable cash. That is absolutely world-class financial discipline. It shows you that their reported earnings are real and high quality. They are true masters of their craft in this department.
So what do they do with that mountain of cash that they generate so efficiently? They give it directly back to you, the shareholder. $4.8 billion was returned to investors in this quarter alone. This is the deal you make when you own P&G. You tolerate the slow, boring growth, and in exchange, they back up the armored truck and just dump piles of cash on your front lawn. This dividend and buyback engine is the reason this stock doesn't collapse on bad news. It provides a powerful floor of support.
Yeah, the scale is incredible, I'll give you that. But let's ask the skeptical question here. Is this a sign of strength, or is it a sign of stagnation? Are they returning all this cash because it's the absolute best use of that capital, or is it because they simply have no better ideas? A company with huge growth opportunities in front of it would be reinvesting that money to fuel that growth, not just handing it all back. Is this fortress so old and mature that it's no longer capable of building new towers and can only focus on paying for the upkeep of the existing walls? This feels like a company admitting its high-growth days are long gone.
Okay, time to bring it all home. Let's put everything on the scales for the final verdict. We've inspected all the evidence. We've seen the flat foundation of zero organic growth. We've examined the uneven pillars, with modern beauty holding strong while the legacy baby care pillar is actively crumbling. We have felt the intense pressure squeezing profitability, and we have marveled at the sheer, awesome power of the cash flow fortress. It's time to weigh it all and decide, is Procter Gamble an opportunity to build wealth, or is it a value trap?
So what does management themselves say is coming next? Here's their own forecast for the full year. But look closely at these ranges they're giving. Organic sales growth, 0 to 4%. Core EPS growth, 0 to 4%. The low end of their own official guidance is literally zero growth. They are telling you to your face that the worst-case scenario is that they go nowhere. This isn't a forecast that screams confidence. It's a signal of deep uncertainty from management itself. They're telling the market to get ready for more of the same. A slow-moving giant that will keep paying you, but won't be going anywhere fast.
So it all comes down to this. The bull case, the opportunity, is simple. You are buying a cash flow fortress, an absolute machine that generates billions and returns it to you like clockwork. You're betting on the continued strength in high-margin beauty, and you're trusting that management can execute on its productivity plans and deliver that promised second-half acceleration. But the bear case, the trap, is just as compelling. You could be buying a museum. It looks impressive from the outside, but it's not growing. You're buying a company with zero organic growth, negative volume trends, and intense margin pressure, with its biggest legacy brands and what looks like a permanent structural decline.
And so this is the final provocative thought we want to leave you with. The fortress itself, the cash flow, is secure. It's not going to crumble tomorrow. But it is a massive, heavy fortress built on a foundation that is now completely flat. The question you, as an investor, have to answer is this. Can they find a way to reignite growth and start building new floors on top of that flat foundation? Or is this the new reality, where the sheer weight of this company, with no upward momentum, will eventually cause that flat ground beneath it to slowly but surely begin to sink? That is the billion-dollar question, and figuring that out is how you forge a stronger portfolio. We'll be watching.